Dinner time. Not without the farm. Not without water, fertile ground, or machines to plow it. Not without safekeeping, distribution, and a top-up every now and then. Not without the wholesaler, the retailer, or the bank that backs them all. Dinner time. Not without business. Standard Bank. It can be.
Welcome to the last episode of the 4-part online series of the Standard Bank SME Summit in partnership with Business Day. My name is Pavlo Phitidis, and you, all of you, are the single biggest investors in the South African economy, and we together hold the key to its future. Throughout the series, we've shared with you insights from the latest industry insights, intelligence, business activities and behaviors that make businesses work. In the first part, we started with mindset, because mindset governs it all. If you think about it, the only thing you have 100% control over is the way that you think and behave. The way you think determines your behavior. The way you behave gives you the outcome of not only your business, but life. Getting the right mindset was crucial. Next, in the second series, we looked at how to reset a business to be relevant in a changing world. What worked before COVID won't work during COVID or at the end of COVID, which looks to be 5, 6, 7 years down the line. How do you keep your business relevant in a changed world was essential to lead up to the third episode, which is about how you rebuild a business that you are sure is relevant in that changing world. Throughout the time together, we have worked with audience members who are seasoned, resilient business owners, people who've been through it the whole way through. And what we're going to do in today's event is we're going to talk about how you reignite, accelerate your growth, get to that next level on a reset business that's been rebuilt because you have the right mindset. We're going to talk about different growth strategies. We're going to talk about how to fund them to bring them to life. And we're going to talk about how to make it all happen. I see we have a number of people joining us. Victor Chiatvezi from Tripolo, who is taking over the continent with his cargo software platform. Dumisani Msomi from Imvelo Solar Power, who's hopefully seeing the opportunity in the Eskom crisis. I see we have Pierre Reeves from True Lies Forensics. When truth is stranger than a Netflix crime drama, I hope you're picking up on a lot of that work, Pierre. And we have Dr. Ketsiwe Dlamini from Triple C Advisory, which specializes in optimizing performance by harnessing diversity. You know, the more work we do internationally, the more I see this as a cornerstone of South African competitiveness. I also see Khomotso Simango from Rotokakala toilet paper. Did I say that right? Is it Rotokala or Rotokakala? In South Africa, we understand exactly what that means. I hope you got a massive spike of business around the COVID crisis last year. Right around the world, toilet paper was the business to be in March and April. Ladies and gentlemen, you all have access to the live chat section in the streaming page. Let us know your questions. Let us know your thoughts. Let us know your opinions. Let us know your biggest challenges and your biggest opportunities. And we'll work hard to try and give you answers to them. Right now, everyone is facing challenges. Take advantage of the panel that I'm going to be introducing you to in order to get an insight from people who've done it and those who haven't done it, people who've seen it and those who haven't seen it, because of the success in their own businesses, will have a point of view that might give you a perspective that opens a door to your opportunity. So with that, I'm going to introduce you to my panel. First off, I have Gaurav Nair, co-founder and partner at Geltec Fund Management. Next to me, I have Dr. Tirani Mabunda, who is a professional auctioneer and founder at Tirani Auctioneers. I have Brendan Mayer, CEO at Swan Electrical. And then finally, I have Bernadette Colborne, Executive Head of Trade and Supply Finance at Standard Bank. There's a lot of ground to cover, so let's get started. We're going to make this a very practical session, and to do so, I'm going to start with you, Tirani. What brought you to auctioneering?
I went into auctioneering accidentally. I've always had an academic, streak, and I was doing consulting at the time in 2000, and I had a 10-key project that involved me also disposing of the excess machinery. We're rationalizing the assets or the business of a client. And I had to bring an auctioneer at the tail end of a 2-year project after writing volumes and volumes of reports. And this guy came in right at the end. His people came in 2 weeks before. He came in on the day of the auction. And he weaved his magic with his rolling tongue. And he actually earned more than I did. But that's not what attracted me. It was just the art.
The art of auctioning?
Yes.
Is it an art or is it a science?
It's an art.
What makes it an art?
Well, there are so many things involved. Most people see it's not even 10%. In the past, not now after COVID, because we no longer, I haven't done a live auction in 2 years. We're doing it online now. So that's where you'll see that, but what makes it an art is that there are so many things involved. It's not just the quick talking.
So you need to understand what the product is or what the goods are that you're selling. You need to understand the audience.
It's mostly marketing.
To understand how to read the audience, I'm guessing?
Yes.
When you say mostly marketing, how so?
Auction is the truest form of demand and supply. And most people, by the way, right on that point, they think that auctioneers thrive when there is a downturn. It's not true.
You're thriving all the time, aren't you?
No, mostly when it's an upturn, because you then have a scarcity of assets and your prices will shoot through the roof.
Right. So
whereas in a downturn, there's oversupply,
a lot of supply.
And you do a hell of a lot of work, but you don't make money.
What's the most expensive thing you've ever auctioned?
It was a farm, which I sold for 80 million. And funnily, the auction lasted about 3 minutes.
3 minutes?
Yes.
Did they pay cash?
The guy paid on the same day.
On the same day?
In fact, when the hammer fell, or the gavel fell, the guy turned around and he said, "Can I put a fence on my property?" And Investec were the client. And they said, "But we have to go through payments." He says, "No, your money will be in your account this afternoon."
There we go. Bernadette, you must have seen a lot of funding flow to and from businesses. Within the bank itself, what has the trend been around funding supply chain especially? Because what COVID did was completely slow down the global supply chain. How did it affect your business?
Well, during the initial stages of COVID, definitely we saw a downturn, especially in the movement of imports, exports, ports shutting down, lockdown affecting movement of goods. But during that period, we identified the opportunity to take a step back and say, we have businesses that we need to support. Africa's our home, we drive for growth. We've got to grow businesses in order to drive them, in order to allow them to grow. So we took a stance of providing COVID loans throughout Standard Bank, and I'm sure most people have been aware of that. But aside from that, in the trade space, we help the clients in the supply chain to look at them differently and say, we understand the risk.
What does that mean? When you say to look at your supply chain differently, because the environment of COVID was dramatically different.
Absolutely.
So how did you, if I knocked on your door and I said, I'm looking for trade finance, I need to import my products from wherever it may be, how would you help me look at that differently to understand my own risk in making that investment in stock or product?
Well, we will then look at your cash flow cycle. How does it impact your receivables in order for you to run your business and continue in the local market? Bearing in mind your supply chain also encompasses the entire local market as well, from your freight, insurance, your local buyers, probably suppliers as well. And looking at that holistically and saying to the client, let's take that on board. Who are these clients? Who are your off-takers? Who are you buying from? How are you moving your goods? How can we connect that whole value chain for you in one transaction? So from end to end, how do we manage a suite for you? How do we provide those solutions to you end to end, from expanding your business
So
to bringing
So what
it
you're
on
saying
board?
to me is your evaluation is all around risk.
Yes.
And for so long as I can engage with you and enjoy that conversation, I might learn about the risk in my own business.
Correct.
That's a
100%.
very nice benefit. Brendan, you've seen a lot in the last year and a half, 2 years. Just explain to me in a nutshell what your business does.
So we import various low voltage electrical products into South Africa, mainly from China. We get products mainly from Turkey, China, and India. 90% of the products come from China through our own manufacturing warehouse. We obviously bring everything through one specific warehouse so we can manage the quality and the control around the products that we bring into South Africa. Ultimately, all products that you bring into South Africa have got some form of registration through NRCS, who's the national regulator at the moment in South Africa. And they ultimately give us a test report, and we then distribute those products to our national offices.
Give us an example. Give us an example of 3 products that we would be familiar with.
For example, in your residential home, you'll have a DB board, you'll have a break in your DB board, you will have a
So the
change of a
DB board
switch.
is the thing that sparks and smokes and does all that kind of stuff when Eskom switches on, then off, then off, then on, then on, then off, and off, then on.
Yes, we have seen through our technical division there has been a lot of product failures, whether it be appliances or even around certain products that aren't properly or don't have surge arresters attached to it. So there have been a lot of products that have actually failed. But yes, it does have an impact on the grid. At the moment, we sell products. Sadly, when the economy and we do have load shedding, we do sell a lot of the products into South Africa around changeover switches, automatic transfer switches, but ultimately mainly to the hospitals that really need that transfer of power when the electricity goes down. And it's important that they have those things in place when the energy faults.
So in your business, you've got locations, as I understand,
Correct.
and in those locations you carry stock.
Yes.
And who do you sell that stock to?
So our major model is that we supply all the electrical wholesale market. We've got wholesalers, we've got OEMs, which is original equipment manufacturers, and major panel builders that do builds for hospitals or residential developments, or whether it be shopping centers, etc. But our main model is electrical wholesalers, and we supply through them and the independents. A good example would be like Voltex. They're obviously listed in ARB, but we also have other independents, for example, more family-owned wholesale businesses that we supply. We currently have in excess of 750 on book nationally, and we supply all our electrical products through our national offices.
Gaurav, don't you wish that equity was as easy to explain as an electrical wholesale product? Because it's this nefarious thing. It's an idea of value. At Geltech, how do you understand, how do you communicate, how do you talk to the value of equity when you're looking to fund a business by acquiring shares in the business for the funding that you provide?
Well, Pavlo, when it comes to equity funding, it's not only difficult to understand, as you say, but also quite a touchy subject. Business owners, they have poured in time, money, effort, blood, sweat, and tears to grow their business. And the idea of giving up a stake of that business, it's almost like giving up a part of their baby. And not only are they giving up potential future profits or a part of it, but they're also potentially giving up control for people who have enjoyed making decisions themselves the entire time they've been running their business. And so talking to it, what you actually have to show the business owner is the value it's going to add to their business. That in fact, what they will get out of it is not just the funding for growth, funding that's based on the future of their business and allowing them to get there, but also the extra value add they'll get from the relationship, from someone to bounce strategy off, from someone to help them with their networks, for someone to help them connect them to other people, etc. And so that's the real value of the equity is all of that put together. Yeah.
You know, it was so interesting. In this last week, there's a business that I've been working with that's located in the United Kingdom that got funding out of Silicon Valley. And after they had agreed to do the deal, in other words, the business needed money for its next level of growth to reignite the opportunities that it's prepared itself for during COVID. And the funder wanted to invest in the business in order to support that growth because they believed in the business. And after they agreed the deal, beyond the money that was provided, what they did with this business owner and his team is they did a due diligence. They checked in on all the code that underpins this technology business's platform. And in doing so, they did two things. The first thing they did is make sure that the code was authentic, that the code was proprietary, that it was native code. It wasn't hacked together, and the actual platform of this technology business was owned by the company. And then the next thing they did, when you talk to value beyond money, is Gaurav, they went and they got their team in Silicon Valley who have made upwards of 782 investments in technology businesses and said, what should your technology development roadmap in the next 5, 10, 15 years look like based on the insights we can bring to the table? And this business owner said to me, that conversation alone was worth more than all the money they invested. So the point you make around an equity investor is that beyond the money, beyond the transaction, we as business owners must be clear about what additional value they can bring. I want to talk about growth because we have reset businesses, we have rebuilt businesses, and you can get growth in a number of areas. You're either going to find it by buying out a competitor who has not reset or rebuilt their business and is struggling today. You might find it by buying plant and equipment for 50 cents in the rand, 60 cents in the rand, as opposed to new buy. You can find it buying stock. You can find it buying office furniture. You can find it investing in people. You can find it investing in marketing. And you can find it in establishing or buying technology. Tarani, what are you seeing out there in the marketplace? Is there a lot of stock available right across industry? And how do you find that stock? How do you source that stock? How do you communicate that stock's availability to the broad audience of businesses that would be good buyers for that stock?
There is, unfortunately, with COVID, a number of things happened in the supply chain. So there were times when the OEMs, as was mentioned earlier, the original equipment manufacturers, you know, some of the supply chain elements didn't work well. So there is scarcity in the market, particularly in certain segments, like your white fleet, for instance.
Give me an example. What is white fleet?
Vehicles. There is scarcity. So what that has done is that second-hand or used is pricey currently because dealers can't find stock. At some point, even manufacturers didn't have stock. They were also coming to the second-hand market to buy so that they can have on the floor.
Because of the challenges and problems that emerged in supply chains from COVID.
Definitely. So the market has not adjusted fully currently. We had an auction yesterday, for instance. We had more than 300 cars. The prices were crazy.
Where did the cars come from? Did they come
Those
from
were
a business?
repossessed cars. We were selling for the bank, for Absa Bank, and those were repossessed cars.
So they are for you and me as members of the public?
It's mostly dealers, but we have a lot of members of the public currently who come to the platform. But the members of the public didn't see anything yesterday because dealers were buying above trade.
That's amazing.
Yes.
So in many ways, the argument that if your business is the business of selling cars and you can't get new cars from supply chains right around the world because of microchip issues and all sorts of other issues.
Exactly.
Then I can come to you and instead of buying at a new price, I can buy a pre-owned price and do my thing as a dealer to add value to that vehicle and on-sell it to consumers.
Of course. Well, the model ideally should work where a dealer should be looking to buy a trade less up to 20% sometimes, depending on condition. But it's not like that. And their margin will be squeezed because if a dealer is buying a trade plus 5 or 10%, he has very little margin to valet, to fix, to buy new tires or whatever it is that he needs to do before he puts it on the floor to retail. You know?
So if I'm a business owner and I want to buy stock, and the stock might be a white fleet, vehicles, it might be a yellow fleet, so it could be plant and equipment. It might be raw materials. It might be finished product. Whatever the industry I'm in, if I want to buy it from you, can I negotiate with you pre-auction to get that deal not in the auction, but done separately if I know that you have been given the stock to sell as an auctioneer?
It depends who the seller is. If I have a private seller where he has given me a reserve, I can do that. But if it's repossessed stock like I'm telling you we sold yesterday, or if it's a liquidated asset, the seller who it was liquidated from, or the owner, is no longer the seller. The master of the high court, if it's a liquidation, is now the seller. Or if it's a repossession or like a selling execution, the sheriff is the seller. So it's the court which is the seller. Now, there has to be transparency in that instance. Because remember, if a bank repossesses a car and they want to sell it now privately and agree whatever price with the private buyer, and they don't recover the full amount, they're entitled to still go after me for the balance. Now, as a person who is the judgment debtor, I'm entitled to know how it was maximized in terms of fetching the highest price. So it has to go right to auction where it's transparent. I must see the audit trail of the transaction to say that this is the highest price that the market could offer. So I can't offer it on a private treaty basis.
Understood. Bernadette, I've gone to Terani. I'm in the business of office furniture, for example. He has a lot of office furniture from a former business that has failed and is now looking to liquidate itself. I want to acquire that office furniture. How would the bank view that?
Well, I guess all banks would fund a client provided they can see the intrinsic net realizable value of that.
What is
asset.
that word? What do those words mean, net realizable value?
So I guess when you purchase it and then you're going to sell it or you're going to use it, what are you going to recuperate out of it? What are your investment? Is it going to bring you value into the business?
So then if I understand correctly, what you said earlier is you look at the risk of the entire transaction. So you're going to look for a couple of things. Firstly, you're going to make sure that the product I'm buying is the product that
Correct.
I'm selling.
Correct.
Because if I can't sell it, like you've just said, I can never recover the cost,
The cost,
behind it, which means I can't fund the bank or pay the bank
pay
back.
the bank back.
So when you look at me acquiring the stock, although it's in my supply chain, are you evaluating my risk by looking at who my customers are and where I will be selling it?
100%.
What do I need to show you?
Well, you need to show me your data book. You need to show me who your suppliers are, what those terms look like, and how that will impact your cash flow cycle. Is there a 90-day, 60-day, 180-day? And what can we do to support that period for you, provided your off-takers have the appetite or you've got those buyers to actually sell those goods to them?
Do I need those buyers agreed beforehand, or what if I'm in general trade?
Well, if in general trade, it makes it a little bit more difficult because it's on the shelf.
Okay, so what you're saying to me is that from a banking position, any bank would look to evaluate the entire cash flow cycle of me coming to Tirani, getting product for 50 cents in the rand, 60 cents in the rand, vehicles for 80 cents in the rand, whatever the case may be. And before you're prepared to fund that, you want to be sure that you can evaluate whether I can sell it or not.
Correct.
Brendan, how do you evaluate your future forecast? Do you have to secure contracts with certain clients? Does that give you more validity in being able to confidently look at a bank and say, I've gone to Tirani, I've gotten my products at a discount because of the crisis in the economy, and on that basis, I have got offtake or demand for these products already organized, a contract versus the fact that you've got 11 distribution points and you've got a history of trading that product. How do you evaluate and weigh up the two?
Well, I think today you don't get many contracts. I mean, let's be clear. I think they're mainly, even if you had to ask any customer for a forecast of what they're predicting for us in order to bring our own products in, as a simple example, they're very reluctant to do that. So I think it's pretty much a month to month in respect to supply. You've got consumers and customers. And I think what was mentioned earlier, you're looking at your working capital cycle from a debtors and a creditors perspective to see how much cash you got available in order to buy that acquisition or that asset. And that asset will give you some form of benefit and growth going forward in your entire business. That's the only way you're going to be able to generate revenue. From our perspective, as we import electrical products, we don't know what our consumers would require. We do, however, see when there's load shedding, there's obviously a need and a demand for our Pacific product. We've seen certain products obviously pick up. For example, our DC solar range product line, whether it be changeover switches around the load shedding, and that's one side. But in electrical wholesale, it has been affected in some way, as well as the project division. We've seen the construction market, and where Tarani is talking about earlier, is where a lot of the construction companies have really struggled. We've seen, obviously, Basil Reed in 2014 was the biggest construction business. They're no longer around. You've got Marion Roberts, who's also been impacted in some form of a way, and so has Group 5. So the construction market has really taken a massive impact. In respect to Tarani's market, I think it's mainly around motor vehicles and an opportunity to buy. So from our perspective, we would look at that opportunity to see how we can improve our fleet of vehicles and the delivery vehicles and what we look to transport our stock to all our customers in.
So actually, there might be a really good opportunity for you today in a world of crisis to switch out an old fleet for a more cost-efficient fleet or a more economically viable fleet.
Definitely. So from our perspective, we obviously do a lot of kilometers on our vehicles, and we obviously want to turn those vehicles because as they get older, they become more costly to run. But we've got a bit of a blend at the moment. We've seen, whether it be from a logistics perspective, sometimes it's cheaper to rather courier certain products to our customers nationally, vis-a-vis more locally, we'll obviously rather transport in vehicle fleets. But you are right, Pavlo. If there's an opportunity to swap out vehicles at a lower rate and obviously a younger fleet, then definitely it's worthwhile looking at.
That must be quite a complicated transaction, Bernadette. If Brendan wants to take his entire fleet to Tirani to say, sell it, and I want to buy and replace that fleet with other stock that Tirani has, evaluating the risk and balancing the value of that investment from a banking point of view must be quite complicated.
Yes, absolutely. It is complicated. I mean, you're going to get rid of your old stock. You're going to get new stock. Is that new stock going to turn over what you wanted to turn over? I'm assuming it would be, given that you're going to get rid of the old one. So I think we've got to take everything into account on that entire supply chain based on the business that Brendan is running.
Gaurav, you know what? Stock, easy to evaluate. If I use Tirani's words, it's got an NRV, a net realizable value. Plant and equipment, easy to evaluate. If I'm buying plant and equipment, I know what I need. Hopefully, I understand how it works. I can evaluate it. I can buy it. But what happens if I want to grow my business by acquiring a competitor or acquiring new talent, different talent in order to help me get to the next level, or investing in a big marketing drive? So advertising and campaigns, or investing in underlying software to improve the efficiency of my business. My experience is that banks aren't strong on investing in those intangible assets. From an equity point of view, is that something you would look at? And if so, how do you look at it?
Pavlo, I mean, yeah, we do find in general that when it comes to banks and debt, they tend to look at the history of a business and what it has been achieving. And is that enough to then repay the loan that you're taking out? However, when it comes to equity, we look forward. And so those kind of investments, like investing into talent or investing into new systems, or investing by buying a competitor or entering a new market, those kind of investments, typically debt funders don't do those kind of investments. And that's what we look at with equity funding. However, just because it's equity funding, we still want to make sure as much as possible that we're taking an informed decision. So we want to see the business owner has done research into what is the talent going to do for them, that in fact adding the extra people will in fact result in more business, or that the system has been proven in other cases to result in efficiencies, or that they have the know-how in entering into this new market. And so even though it's an equity investment into something that's intangible and an investment into growth, it is still an informed decision in terms of the risk we're taking.
So give me an example. Let's say for my next level growth opportunity, I'm going to invest in marketing. I need to tell the world that I have a reset business that's been rebuilt, that we're getting good performance with our clients, and our clients are constantly buying from us. And I've operated out of Gauteng, and now I want to enter into the Western Cape or KZN. And Gaurav, I'm coming to you because the bank won't fund my marketing program. I want you to fund my marketing program. What are the principal ideas around how you would evaluate that? What do I need to show you to give you confidence that my ability to take the money that I'm going to get from you, invested in my marketing, will give me performance in the business so that you can get your return?
So Pablo, I guess if we look at just financing the marketing, then initially we want to make sure that there is a market there and that the business owner has taken some steps to actually prove that, whether it is trying a trial marketing campaign, which you can do with digital marketing. You can do it at a much smaller scale initially. And then you can measure very carefully and much more certainly than in the old world of marketing, your return on that investment. It does for X spent on marketing, how many customers come through the door? How many of those customers then convert to sales? And then after we have peace of mind that there is indeed a market and that the marketing budget is going to increase in the marketing budget, it's going to result in more business, we want to make sure that everything else is there to support it, that there's a capacity to actually produce the products or services, that there's working capital to pay the suppliers and then wait until your customers pay you. So we then look at everything around that. And is the marketing budget enough? Or do you actually need more capital? Do you need to invest in more systems? Do you need more capacity? Because the marketing on its own may not be enough, because once it brings the business through, you then need to be able to service that business.
Right, so I need to have pretty much in the same instance as Bernadette, who wants to evaluate the entire risk related to the funding request. You would do the same. But my understanding is this. From a bank point of view, I will give you 1,000 Rand, I will charge you 10%, and the way that I make my money is by being paid back the 1,000 Rand plus the 10%, which is an additional, am I right, Bernadette, 1,000 Rand? Or 100?
100.
Okay, so that's how a bank makes its money. I understand with Brendan's business. Brendan imports a product for 1,000 Rand, wholesales it for 1,200 Rand, and makes 200 Rand on the product. In Tirani's case, there's a product that gets auctioned for 1,000 Rand, and Tirani has an auctioneer fee of 5% or 10%. That's how he makes his business. As an equity investor, how do you make your return? What actually is your inventory or the product that you're offering for which, when I take it on, I need to pay you back that plus something for you to get your return? How does it work in equity?
So when we invest in equity and invest in a business owner's business, we're taking much more risk than in the case of a bank. It's much more uncertain, even though we're in the position where we're evaluating all the risks, similar to Bernadette. And so what the business owner is giving up is a stake in their business. And we already talked about how what they get out of that. And what we're hoping to do is to then help the business owner grow that business. Through the investment in marketing, to take that example, the business now starts getting more revenue and they have more profits, etc. And so now that the business is producing more cash flows, the equity stake that we have invested in is worth more. Ultimately, though, we do want to get out of the business. We do want to get our money back. And so at that point, the business owner either buys us back or sells out with us to a new investor who's looking for an investment.
Okay, so in effect, if I were to look at your business as a product business, the stock item you have is money, and the return you want is the ability to grow that money through the growth of the business itself. Yes, Gaurav is frozen. I want to get on to some of the questions that I see our audience members are already providing us. And there's a great question that's come through, Brendan, which I want to direct to you. You in Swan, if I've understood correctly, have acquired businesses before as a strategy to grow your business to the next level. What do you look for if you are acquiring a business? Are you looking for a competitor that hasn't reset and rebuilt their business? Or are you looking for a business that has access to new customers and new markets? How do you evaluate the acquisition of a business to support your next level of growth?
Well, I think there's various aspects we look at. First of all, I think it needs to be a good strategic fit. Ultimately, it needs to complement our business either through form of product basket or through consumers or new business development or new areas of growth physically. But I think also the person or the initial owner, we believe they need to be part of our business. Because when you've got a person that was initially in charge or running of that business, whether it be the managing director, whatever it might be, he still has a large contribution to make to that business. So yes, we did buy a competitor. We bought a competitor in KZN. We left the KZN area as an area of growth right to the end because it's a very competitive area, as we know. And ultimately, they were in the area for more than 24, 25 years. And it was an opportunity for us to get 25 years of worth of business than to rather start on our own. The businesses complemented each other. They mirrored it. I think the price was right, and that's obviously very, very important. But I think the shareholders all had the same vision and aspirations where we saw the businesses could go together as a collective. Today, I'm very proud that all the partners and shareholders that we do have complement each other in various ways. So, for example, I'm more financial business orientated, where Stephen's more technical orientated. So we really complement each other very, very well.
Okay, so when you're acquiring a potential business as your next level of growth opportunity, it's a lot more than just the stock in the business. The culture of the business would matter. The systems that make that business function and work would matter. The similarity in customer bases would matter.
Yes.
The culture would matter. How do you evaluate culture?
All those aspects are very important because we actually took that all into consideration. You know, even from a skill set, what they would bring to the table that we might not have had as an offering within our own business. So I think from that perspective, you need to evaluate all of that. You can't put a price to that. But it's imperative that you do look at that because when you incorporate two businesses together with different cultures, different skill sets, different markets, it becomes difficult. So when you're doing an acquisition of some sort, even if it is a competitor, and it's a brand change or a switch of a product, whatever it might be, it needs to fit. And you need to put a lot of hard work. It's not easy. But I think once you've broken the camel's back after 6 months, it's only generally good terms that ultimately we all share as directors and shareholders in the business.
You know, they say that growing through acquisition is 5% getting the deal done and then 95% settling the deal in. And if I listen carefully to what you've said, you've been very fortunate in the acquisitions you've made. Because if you get the fit right, the blend of the team that you're acquiring, the business you're acquiring, the culture, the values of the leadership team coming on board with you, that's where the game is either lost or won.
Definitely.
There's another great question coming out for Tirani. Tirani, what does Footstoots mean? When I come to an auction to buy stock or a product, we have an audience member saying, does Footstoots guarantee that what I'm buying is what I'm buying, or how does Footstoots work?
The literal meaning of Footstoots means you're buying it as is, where it is, with its faults and benefits, whatever it is. But people must not misunderstand Footstoots. Because it doesn't mean that you don't have the opportunity to inspect the asset before you buy it. So Footstoots, it's not even an excuse by an auctioneer to woodwink a buyer into buying something that is not fit for purpose or it's faulty. So you have the opportunity to inspect the asset. You can even bring experts. If you are a member of AA, you can bring your AA specialist or a mechanic to inspect this car that you want to buy. I had earlier, you know, my fellow panelists saying that they would like to buy vehicles. I mean, we had about, I think, 15 yesterday, Ford Rangers that were below 30,000 mileage-wise, which are almost
brand new.
Yes, definitely. And we almost sell assets that are still having motor plan, maybe disconnected, but you can go to the manufacturer, they'll check the history, it's all digital. And then they reinstate your motor plan. But you're still buying it Footstoots. You could go to the dealer, he'll give you maybe 6-month warranty. But if you're buying something that is on motor plan, you have the warranty already
in place.
from the OEM himself. So, but well, to answer your question, Footstoots is as is, where is. But it's not a trick to crook someone into buying something that is not fit for purpose.
You know what? I've got a big issue with this word pivot.
Yeah.
You've got to pivot. You've got to pivot. You've always got to change your strategy. Change your strategy, they say. And one of my biggest arguments in March, April, May, June, July last year, where many businesses were struggling and many businesses started to do things that they had no understanding of in order to get cash flow in. I saw office furniture manufacturers move into the area of making hand sanitizers, for example.
Yes.
And when you move into a completely different segment, a completely different business, you don't understand the risks, you don't know how to interpret the risks, you're subjecting yourself to a lot of risk per se. When you see and when you're auctioning products and services or plant and equipment, whatever the case might be, the best person to be in that auction is someone who's in that industry or sector, I would guess. Because if I can come and inspect the quality of the plant or the quality of the stock or the quality of the product, that gives me the confidence to know if I'm getting it at a good price or not, I would guess. Is that also a good way to form a relationship with an auctioneer?
No, true. I like the question where you started with it in terms of pivoting. You know, and you spoke about March, April, May. You know, something very strange happened. We had an auction on a Tuesday, when the president spoke on a Sunday and said,
The previous,
crowds-
previous Sunday
no,
or
no.
the Sunday
It's
ahead?
the Sunday before the Tuesday.
Okay.
He had the very first family meeting, and he says, we can't do live auctions anymore, basically, because we're limited to 100. We normally attract more than 300 people to our auctions live. So we had to pivot that auction from a Tuesday, because we had already marketed. People were coming on the Monday already for viewing. We had to pivot it, change it into online, and we had never done it with the bank online for the Thursday, and it worked like a charm. And ever since, from that 2020 in March, in March, we've never done a live auction for the bank.
Will you ever go back to live auctions?
The bank doesn't want to, because it works like a charm. We close the auction like we're sitting now on a big screen. So the question you're asking in terms of the relationship with auctioneers, it could be someone wanting to sell assets. And in fact, the question you asked earlier about marketing, we were on a marketing drive earlier. And I said to my people, stop that, because for an auctioneer, if I don't have the stock, marketing can be dangerous for me. Because if I have too many buyers wanting stock, and I only have 2 auctions per month, and we have so many inquiries for vehicles, then I have a problem, because I have more buyers than the stock I can offer.
Bernadette, this asks a very interesting question. Supply and demand of the stock that makes up your supply in a business. How do you evaluate that when someone knocks on the door and says, I'm looking for trade finance, I'm going to grow my business through acquiring a chunk of stock that's become available. I found it through Tirani at an auction. My competitor has failed, and I can get it for 50 cents in the rand.
Well, the client is going to, or the company is going to have to prove to us in terms of his strategy, his forward thinking, in terms of how he's going to move that. What is his plan to move it? How is he going to match it to whatever potential buyers are out there, or however he's going to use the stock? That's the challenge we faced with.
But let me put an example to you. So I worked with this business that had gone to an auction and had gotten gold out of the auction. What the business was a clothing manufacturer. And specifically what this individual's business does is he designs motorbike clothing, motorbike safety clothing. You know, it's got Teflon inside the pants so that when you fall, it doesn't burn. It's got protection for the knees and protection for the elbows and all sorts of things. And specifically, what sets his product apart is he makes it out of denim. And he found a business in the textile industry that had failed. And they had gone and put kilometers of denim into an auctioneer's hands in order to liquidate the stock, to settle their debtors. He wanted to acquire it. Now, he has no immediate takeoff for the product that would come from it. But what he turned around and said to me was this. He showed me the year-on-year increase in the cost of denim from global supply chains. And he said to me, Pavlo, if I invest in this now, I will only be able to sell all this denim in the next 2 years. But the cost of denim inflation is higher than the interest I can earn with my money in the bank. If someone comes to you with an argument like that, does that make it a good investment from a banking perspective?
It would be a good investment, provided you're looking at all the risks associated. I mean, there's a global supply chain that's coming in, and how, added to his product, how can we as a bank look at his business and say, yes, we're prepared to invest, but let's see how we can grow you into other markets and expand your business going into an export type of arrangement or domestically. You might be on the shelf, you might be selling off the shelf, you might be waiting for bikers to come in. However, let's see what we can do for you to distribute that product that you have into a better environment.
So it's actually in your interest to help me sell my stock.
Yep. We can place you on a what we call a trade club or online marketing tool. It gives your name out into global, Africa, local. And you get trusted, vetted partners by global banks and local banks.
That is very cool. I like that. Gaurav, I have a question for you that's come through. Which is the best type of funding, debt or equity, to accelerate growth in my business? How do I make the decision whether I go debt or whether I go equity?
Well, typically, most business owners prefer debt if they can get it, because they're not giving up ownership in their business. However, debt providers, what they look for is can your historical earnings support that level of debt? And are there assets that I can take as security? But debt providers will tell you the most important thing is cash flow. So if an owner is in a position where the funding they need for growth can be supported by debt, then that's usually the route they go down. However, where there isn't the historical cash flows. So I'll give you an example, a concrete example. One of the businesses we were working with, they wanted to buy their suppliers. And they were already buying most of the stock from their supplier. They were their supplier's biggest customer. So right away, by buying the suppliers, they could put in place efficiencies, and it was very sure that they would be able to give a good return on the money, whether it was debt or equity. However, the quantum that was needed, as well as where the return would come from, was based on the future. Their past business was only earning so much, and it couldn't be supported by debt. However, by buying their supplier, the efficiencies they would get out, etc., they would earn a lot more. And so based on that, they had to go for equity funding because the return was coming from future cash flows, not from what they'd done in the past.
So if I listen carefully to what you're saying, an important feature and something for all of us to consider when we go for equity funding. A, we're selling part of our business. We are selling, we're not giving anything away. We are selling shares in our business. So it means we're bringing a new shareholder on board, a new partner on board. B, when we do so, that money is going to be used to grow the business to its next level. In other words, if you're doing 5 million a year in revenues, hopefully it's going to get you to 10 million a year in revenues in the next 2 years or 3 years. But then you need to get out, because if I understood what you said to me, you get funding from funders, the funders want to return. If I want to continue running my business, Gaurav, and I don't want to sell to a corporate entity or list on the stock exchange, how would we understand that element of our relationship should you be the funder that has supported me to get from 5 to 10 million?
So Pavlo, you've hit on a very important point, which is alignment between the equity investor and the business owner. And so that vision of saying, as the business owner saying, I don't want to sell my business, I don't want to list. But at some point, the equity investor does need to get out. And so what we look at then is, at that later stage, putting the business in a position where its cash flows can then support debt. So as I've said many times, debt is backward looking. So through the period of the investment, the cash flows keep growing, enabled by the equity investment that has been made. And then at some point in the future, the cash flows are now big enough for the business owner to take on debt into the business and buy out the equity investor. And then as they pay back that loan, they then end up owning all of their business again, but they've been enabled by that equity investment to reach the next level.
So I'm left with a business. When you need to get out, I'm selling my business at a valuation with a 10 million rand turnover instead of a 5. I can go to a bank because my business is double the size. I've got double the cash flows that I had before. I can raise debt funding from a bank in order to buy you and your funders out so you can get your return. And I'm left with a business double the size, but I need to settle the loan that I've taken from the bank. And once that's done, I'm left with the whole cake, which I can then also eat. Is that the formula we're looking for?
That's exactly right, Pavlo.
next level growth, reignition of a reset and rebuilt business. There are so many opportunities. I see there's a question there around how do I grow my business into overseas markets? I made a big statement at the beginning of this year on radio, and I argued strongly that South Africa is a fantastic place to build an international business. Obviously, it depends on what sector or industry you're in. But I'd like all of you to think about this for a minute. Firstly, when COVID came, which was a shock to the entire world, yes, we all felt it. Yes, we've all lived it. And yes, we are all currently, and still a lot of us are suffering severely through it. But I'll tell you what distinguished South Africans compared to what I saw in the United States, in Europe, in the United Kingdom, which is mostly where I have my experience, is I saw a mindset that had a natural built-in resilience. Because with respect, we get so little support from the mechanics and machinery of government in building our economy, it's left up to us with a strong survival instinct to constantly adapt and do what's necessary to build our own businesses. So mindset from a South African point of view, for so long as you choose to be positive, is a key competitive advantage. The second advantage was this. We have a very competitive economy, and it's well developed. I'm talking about the formal economy. If you build a business in South Africa that does well in the formal economy here, it puts you in a position where you're building a business that could be relevant in competitive formal economies in developed economies like the United States or Europe or the United Kingdom. The big benefit is that when you build here, because South Africa doesn't feature at all in developed economies, you're building in the tall grass without competitors looking and seeing how you're doing what you're doing. In those two elements alone lie the seed of how you build a global business from South Africa as an incubator that will find relevance in economies where you can get dollars, pounds, and euros on the back of a rand cost base. Many South African business owners have adopted that as their next level of opportunity. And I would encourage all of you to think hard and close around what that could look like for you. As we come to an end, I want to share one last thought with you from my side. If you don't get your mindset right, if you do not reset your business, if you do not rebuild it, and if you do not take advantage of where we are today to reignite it, you only have yourself to blame. I want to end off with some closing statements from my fantastic panel who are going to share similar insights, I hope, around what lies ahead. Tirani, in the next 3 to 5 years, what's your biggest opportunity and how are you going to make it happen?
Within the auction space, which is what I'm talking about today, but I have many other, businesses, as you would know, in different industries. But within the auction space, all we want to do is to consolidate the position we are in, where we are servicing newer and newer clients in terms of financial institutions. We have a lot of a captive market in terms of the buyers. As you'd know, we're the biggest black-owned auction company. And most people come to us to look for stock. And we're currently looking for the stock with some of the financial institutions that we're not working with. And in the next 5 years, we're looking to consolidate our position and in the platform of online auctioning mainly.
Fantastic. So your big opportunity is to let the world know, specifically the financial institutions, that you're the place to go.
We are, indeed.
Bernadette, what lies ahead in the bank for the next 5 years, especially around supply chain funding?
I think the key strategic focus is growing the market in South Africa, and particularly SMEs, because from an international chamber of commerce, that's where the financial need is in the SME market. And to help those customers grow, to help them expand their businesses cross-border into Africa, globally, earn dollars, pounds, euro, awesome against the rand, and help them move their goods as well.
You know what's wonderful about your business? The equation for growth is very simple. If your clients and customers don't grow, you don't.
Absolutely.
So it's in your interest to get them to grow.
Absolutely.
Brendan, what lies ahead for you?
Well, you know, Pavlo, I think as a company, as Swan and the group of companies that fall under our umbrella, we've been very fortunate with the growth that we've been able to achieve in the South African market, especially over the last 2 to 3 years. Yes, load shedding has helped in some instances, but we've grown our customer base. We've seen this market locally as a growing market. We've grown our electrical wholesale business phenomenally well over the last 2 to 3 years. So there's a huge need for the products that we import into South Africa currently, because we are a mid-tier brand offering good quality products at a good price with a service that goes with it. However, we also see the mid-tier strategy for us. We're looking at an international expansion arm at the moment. It's not going to be a gunshot approach. It'll be a rifle approach. We'll choose the markets that we're wanting to operate that ultimately need the products that we service and sell here in South Africa. We've had a great uptake in our product basket. We see huge potential now currently in South Africa with the DC range that we're bringing in, and a lot of the wholesalers, especially the consumers now, are trying to move off the grid. You would have seen the latest announcement come out of government. So there's a great need for our product at the moment. We're very proud to have brought in that Pacific range around the DC solar range, and we see already a huge uptake in it. For us to fund this massive expansion only in South Africa is already a very tricky job in order to do every single month. So we're very blessed, we're very fortunate. We're looking to grow this brand even more. It's a brand that people start to get to hear a little bit more, and I hope that both from a local perspective and international perspective, we'll see what we can do, and we hope in 3 years' time we've got a story to tell.
I'm sure you will have. Gaurav, what lies ahead in equity funding for the next 3 to 5 years?
Well, Pavlo, what's been happening more and more is investors are looking for returns, not in the traditional markets of listed equities or listed bonds. And so what lies ahead is investing into the alternatives. And the alternatives are equity funding into small and medium-sized businesses. And what lies over there is that you have really good deals as an equity investor, because a lot of the other funders are not looking there. They find it too difficult, or they don't think it's interesting. So there are really good deals that you're not competing for. There are great businesses that can give great returns if only they could get the equity funding. And so what we see coming ahead in the coming years is more and more investors realizing the opportunity, more and more money coming into this sector, and then that providing business owners the much needed growth, the growth that they are looking for and the growth that our country needs.
Absolutely, and we could not end up with a better note. I'll say it again, we are the single biggest investors in our economy. It is us who have the courage to start a business. It is us who have to have the creativity to do it differently. And it is us who need to practice care for the long journey that it takes to build a business from $1 to $100 million. All of you will be receiving an email with some of the summary points in the thank you mailer after this webinar. Thank you for investing time with us. I hope you got really good value from today. And again, I say it, if you don't do it for your business, nobody else will. Feel free to rewatch the 4 seasons at the SMEsummit.co.za. And again, to my panel, thank you for giving up the most precious thing available to us all, time. From me to all of you, have an entrepreneurial day.
Dinner time. Not without the farm. Not without water. Fertile ground. Or machines to plow it. not without safekeeping. Distribution. And a top-up every now and then. Not without the wholesaler, the retailer, or the bank that backs them all. Dinner time. Not without business. Standard Bank. It can be.